In this video, I have 5, count them, 1, 2, 3, 4, 5 growth stocks that you should be watching right now. I've got a couple stocks on here that you probably haven't heard of elsewhere, and they're pretty neat opportunities that I want to share with you guys. Let's do it. What's going on, everybody? My name is Matthew. Welcome to my channel, and today we're talking about some of the best growth stocks to watch right now. The market continues to shrug off a lot of bad news, and if you've been watching closely, you may have noticed a shift to growth stocks. Here's a list of the 5 growth stocks I'm watching right now and might buy more of. We're getting right into it with the first stock that I don't hear talked about a lot for some reason, is Appian. Appian. Ticker symbol APPN. Appian is a software as a service company, we love those nowadays, that helps companies develop inexpensive and customized apps and software utilizing Appian's team of internal developers. It's a subscription-based business model because they provide continuous support and training for their customers even after the app and software is developed. Oh, and you may have heard of some of their customers. 10% of the Fortune 500 are their customers. On top of that, the Department of Homeland Security, the FDA, the Treasury Department, Army, and the Air Force. Businesses, enterprises, and government bodies are still making the transition to the internet and mobile platforms. Appian is their affordable, quick, quality solution. Now, before we look at all their catalysts and the potential on the horizon, we always want to make sure that our long-term investments have sound financials. So let's jump into the balance sheet real quick. Oh, and one more thing. Since we have 5 stocks to get through, I'm just going to give you the highlights, and one of my favorite ratios on balance sheets is the current ratio. Now listen up, this is important because I'm going to reference this ratio for every stock throughout the video. A current ratio is just current assets over current liabilities, and current simply means that it can be spent or liquidated within the year, like cash, or that it is due or expires within the year, like a loan or obligation. This ratio is important because it tells you just how prepared a company is to handle short-term debt, and as growth stocks, a lot of them take on more debt to finance growth. Now we can hop into the balance sheet. A decent current ratio is anywhere between 1 to 2, and that's what we're looking for here with the Appian Corporation, where they have $255 million in current assets and only $108 million in current liabilities. This means they're flexing a current ratio of a whopping 2.34. Now they're still showing a net loss on their quarterly results, but their losses are shrinking substantially year over year. And just take a look at how efficient these margins are. Their gross margins for subscription are 90%, with their overall gross margin at a whopping 70%.
Additionally,
their cloud subscription revenue retention is up 115%. 115% retention means that not only are their customers staying, they're actually paying for more services from Appian. Appian guarantees that it can train its customers' employees in as little as 2 weeks and develop a fully fledged app in 8 weeks, all for $150,000. Now, $150K might sound like a lot, and it is a lot of time and money saved by the customers as opposed to if they were to do it on their own. See what I did there? Now let's talk catalysts. Not only did they form a strategic alliance with Deloitte to help modernize their government and commercial clients, but they also made an even more strategic move by offering a free app to manage Rona responses for enterprises and governments. In summary, Appian has solid financials for now and has a ton of runway left to take off, especially as the Rona forces businesses to establish an online and mobile presence. Next, we've got another stock that I don't see a lot of people talking about. That's right, back-to-back hidden gems on this channel. Feel free to subscribe. This next stock is called Five9, ticker symbol FIVN. It is a major player in the call center business. Is that right? Surely it's something cooler than call centers. Nope. And before you call this boring, the stock is up 91% in the last 3 months. This stock is covering this issue. Beep boop bop beep boop boop. Ring ring ring. Please hold. Five9 is a cloud-based company that's replacing physical call centers with low-cost virtual call centers, as well as allowing customers to reach you via social media, email, and live chat very easily. Oh, it's a cloud stock. Now I see why it's up almost 100% in 3 months. Octa. What? Using Five9 is a win-win for companies because not only does it save money with a virtual call center, but it also makes their customers' experience much more enjoyable. And for a growth stock, Five9 is a balance sheet babe. Quarantine has me calling balance sheets sexy. Please send help. Seriously though, their current ratio with $394 million in current assets and only $71 million in current liabilities is a sweet sweet 5.5. And remember, anything between 1 to 2 is not too shabby. Their net income did come down a little bit, but their revenues actually increased, and just like Appian, it's no surprise. Let me tell you why. With the Roni Roners, obviously there's a lot more pressure to move physical call centers to become virtual call centers. Everything's becoming virtual now. But here's the biggest catalyst for Five9. You smashing that like button. And you want to know why? Because if you hit that like button, YouTube will show this video to more people. And if more people see this video, more people want to buy Five9. And together, we can sway the markets. Jokes. All seriousness though, these videos do take a lot of time and effort to research and record, so I'd really appreciate just dropping a like. Thank you, moving on. Lastly, Five9 has CRM integration, which means they collect a lot of valuable marketing data. This is partly in thanks to one of their many partnerships, which include the likes of Salesforce, Oracle, Microsoft, Deloitte, Google, Zoom, AT&T, and the list goes on. In summary for this one, they've got great management, stable financials, and oh yeah, a $24 billion addressable market. But now we shift our focus from the cloud to actual clouds, which are a part of our atmosphere, an atmosphere which is suffering from greenhouse gases that are produced by cows. You guessed it, our next stock is none other than Beyond Meat, ticker symbol BYND. You're welcome for that seamless segue from clouds to burger patties, but by the way, our fifth and final stock is another cloud stock in a super hot sector, so make sure you stick around for that. Anyways, if you don't already know, Beyond Meat is a company that produces plant-based or vegan meats. Their products range from burgers, beef, sausage, crumbles, and breakfast sausage, which is apparently different from regular sausage. There are countless long-term catalysts for the stock, and let me just name a few of them. UBS sees the plant-based market as a $1.2 trillion industry. Beyond Meat has the first mover advantage in plant-based meat, and they're continuing to expand this advantage by moving overseas into China. They'll be rolling out into KFC's, Pizza Hut's, Taco Bell's, and Starbucks in mainland China. They also have a moat, otherwise known as their 40% margin on their products, which means if a competitor walks in like Impossible Foods, they have a lot of room to change their pricing and bring it down so they can stay competitive. Oh, you want another one? Another one. The vegan lifestyle is still on the rise. Millions are joining the movement, but you may be surprised to find that most people who buy a Beyond Meat or Impossible Burger are actually not vegans. They're people who just want to try it out. I've personally been that person to try a Beyond Burger or Impossible Burger just because I wanted to see what it tastes like.
And they're legit.
So don't make the assumption that Beyond's sales are directly linked to the vegan population, because they're not. There's actually a big movement right now moving away from traditional red meat because of dietary health concerns, and that's something Beyond can capitalize on. With $415 million in current assets and only $72 million in current liabilities, they've got a stellar current ratio of 5.76. Wowza. And as a side note, they've only got $99 million in total liabilities compared to their $491 million in total assets. Their revenues are surging and their operating income has gone positive and growing. However, their net income is still in the red, but their losses are shrinking dramatically and quickly. With all this being said, Beyond Meat is notoriously overvalued right now, so keep an eye on it and make sure you do some more digging on your own. But in summary, for this one, I see plant-based meat taking over real meat in the long run, and I think Beyond Meat is the best pure play for that in the stock market right now. And speaking of the changing of the old guard from real meat to plant-based, let's talk about another shift within this theme. I'm talking brick and mortar retail to online retail. That's right, our next stock is the Revolve Group, ticker symbol RVLV. The Revolve Group is an e-commerce retailer that's targeting millennials and Gen Zers as they curate luxury brands for apparel, accessories, and footwear. They also own several private label brands. Just one of the many unique things about this company is their marketing strategy, and I believe it's partially how they got their name. The Revolve Group utilizes a network of over 3,500 influencers on social media. And these influencers are people who have millions of followers across several different platforms that they can actually influence just based on things like what they wear, But it's way deeper than that. Revolve is not just an influencer-based trendy company. They're first and foremost a data science company that has proprietary technology to analyze millions upon millions of data points. And this is where the private labels come in handy. First, they analyze user trends within their data. And second, they take their private labels and produce products that are in line with these trends that they find. Then they can send it out to their influencers for marketing, and I think this is a genius funnel. You find a winning product based on tangible data. You create it for your customers and you give it to influencers who will get these customers to buy it. And this is actually a huge reason why I think Revolve will beat out these old brick and mortar retailers, because although these brick and mortar retailers are still using data, they also rely heavily on these people who are supposed to predict the next fashion trend, and then they have to commit to it and buy a lot of inventory. Whereas Revolve is very nimble with their private labels, and they have data that shows you what actually is the trend. They don't have to guess. And obviously it has worked for Revolve because they've been profitable since 2016, which is a very rare sight for any growth stock. They've got $227 million in total current assets. That's about half inventory, half cash, and $123 million in total current liabilities, giving them a current ratio of 1.84. Remember, 1 to 2 is pretty good. Their revenue and net income are both steadily increasing, but that's one area I want to be really honest about, is we don't see a lot of huge growth there. Revolve is not putting up huge 30 to 100+% growth numbers year over year, which we may be accustomed to when talking about growth stocks. So there is some skepticism around whether or not their business is sustainable for long-term exponential growth. But I think the retail industry is making room for them as retail giants like Neiman Marcus, J.Crew, JCPenney, and many others either file or inch closer to filing for bankruptcy. In summary for this one, Revolve has a proven track record of using data and using it extremely well. It's obviously got a great online presence and has always been ahead of the curve in terms of marketing and innovation. And lastly, it's way below its IPO price of $18, and personal opinion, I think that should change. So as promised, for our final stock, we go back into the cloud, and that stock is Zscaler. Ticker symbol ZS. They're a cloud-based cybersecurity company that protects data and users, and they're one of the first to ever do it. Zscaler actually has a first mover advantage over much of the cloud-based cybersecurity sector, which is perhaps why they can say that over 100 companies in the Fortune 500 are their customers. One of their biggest deals is with Microsoft Office 360, which is only getting more use as the pandemic rages and more data and more users need to be protected. Cloud-based cybersecurity is a super hot sector right now. For example, Okta, which I joked about earlier in this video, is up over 100% in the past 3 months. And this sector is only beginning to grow, with one analyst even saying that ZS is the best pure play in the cloud security arena, which we believe is still in the very early innings of taking off. As far as financials go, with $552 million in current assets and $345 million in current liabilities, ZS rocks a current ratio of 1.6. But I do think it's important to note that of the $345 million in current liabilities, almost 80% of it, or $274 million's worth, is just unearned revenue. And this form of liability just means that Zscaler has been paid already for services that they have not yet provided. So that's actually by far one of their biggest current liabilities right now, just having to do more work for their customers. In terms of debt, there's not a lot of it on their balance sheet. I will say, however, ZS recently just had a huge run up to over $100, where it's sitting at right about now. So be careful, be wary, but I do think, in summary for this one, that ZS is in a great position to take advantage of the cybersecurity and cloud space as everyone shifts to working from home or continues to work from home. And just in general, I think cloud-based cybersecurity is a long-term sector to be involved in. If you found any value in this video at all, and I hope you did, please consider dropping a like. That would really help out this video and this channel, and I would greatly appreciate it. Comment down below which stocks you guys are watching. Not only do I love talking to all of you, but I might just make a video out of the stock you suggest. Make sure to subscribe, and this time, listen up. I have a reason why you need to turn on those notifications. We're actually doing a bit of a content push on this channel. As you can see, this is my third video in the past 4 days, which is a lot for me. Additionally, we have a new series coming to this channel where I'll be investing $200 every week into a fresh Robinhood account and doing completely dividend-based investing. So if you want a weekly episode of that, then make sure to subscribe. Lastly, guys, I can't ignore what's going on in the world right now. So if you're interested in supporting the protesters or the Black Lives Matter movement in general, I've left some links in the description below where you can go donate and possibly show some support. The way I see it, guys, donating a few dollars here and there is as painful as missing out on a couple Starbucks coffees. It's really not that bad, and I'm sure you guys are getting those stock market gains, so feel free, if you want, to share that with the links in the description below. And as always, we'll end with the quote of the day: "You can't grow when you're comfortable." Not quite sure who said that, but I'm sure many people have, and I think it relates to not only the growth stocks that we're talking about, where it may be a little uncomfortable to invest in a bit of a speculation or something with maybe uncertain potential, but it also relates just to your mindset. If you just sit and stay in your comfort zone, especially in a time like this when we're in quarantine, you're not going to learn anything new about yourself or in general. As always, thank you so much for watching to this point in the video. It means so much to me and it really helps out the channel. And with that being said, don't forget your peace and thank yous.